Hi, I'm Andy and welcome to my channel about crypto. In this video, I wanted to cover basics of cryptocurrency and blockchain. I realized recently that although I've been running this channel for a while, I haven't actually created a video for complete beginners. So if you know nothing about crypto, or maybe just very little, this video is for you. What we will look at today are some basic terms in crypto space and stuff that you are likely to come across in other videos, which may be a little bit confusing. The purpose of this video is not to cover everything in a lot of detail, because it would probably take hours to do so. But I will put links to my other videos and also some other materials in the description to this video and at the end of the video, so then you can explore those topics in more detail. So first of all, what is crypto? Well, what is blockchain? Blockchain is a technology on which cryptocurrencies and NFTs are built on. And basically, you can imagine it as an open ledger where all the transactions are written, but everyone can actually see them. So people will not be able to see the names next to each transaction, but they'll be able to see from which address, from which wallet the crypto came from and to which wallet it was transferred to. There, everyone is able to see the amounts, times when it happened, and because everyone can see it and every computer on the network is verifying those transactions, there is no way someone can alter the blockchain or create their own version. Or, well, in theory they could if they had at least 51% control of the network, but it would be way too expensive to do so. So basically, by blockchain being open and shared between many different computers, so decentralized, that's what actually makes it secure. And that's what makes it different from traditional financial system or from traditional banks. So you don't have one centralized entity like a bank that controls all the flow of money, but instead you have hundreds of thousands or millions of computers on the network, each with a copy of the blockchain that verified the transactions. So when, let's say, I want to transfer some Bitcoin to my friend, I put that transaction through. It's bundled with other transactions, and together they will form a block. That block is then added to a sequence of blocks, and well, that's how blockchain is formed. The whole concept of a blockchain and all the details can be quite complex, but at the same time quite interesting. I'll put a link in the description to a really good programming course, which is essentially how to create smart contracts in Solidity. But you don't have to actually go through the whole course. The important bit is at the very beginning, when the author of the course explains exactly in much more detail how blockchain works and how it relates to cryptography. And if you want to explore it in more detail, which I think it's worth doing, I would recommend watching that video. I think it's only like half an hour, maybe an hour, but it's a really good, really detailed explanation of how blockchain works at a more technical level. Currently, the main use for blockchain technology is in the form of cryptocurrencies. And on this website here, coingecko.com, you can see the list of, well, majority of cryptocurrencies. There are literally thousands of them, but you don't, of course, have to know the details of all of them. And they are listed here in an order of the size of the market cap. So basically, market cap is the price of an asset multiplied by the quantity of that asset in circulation. So if we look at Bitcoin, we can see that the market cap is close to $1 trillion, well, over $900 billion. And that's essentially the price, $48,705, multiplied by circulating supply of just under 19 million. As you can see here, Bitcoin has close to 1 trillion market cap. It's the biggest cryptocurrency by market capitalization. Ethereum is the second one, and it has almost half of the market cap of Bitcoin. And then the size of the market caps drops rapidly. Whether a particular cryptocurrency has larger or smaller market cap, it doesn't necessarily mean that it's better or worse. It just simply means that the bigger the market cap, the more stable an asset is. You can imagine that, let's say, suddenly there is $10 million influx into Bitcoin. Well, 10 million in comparison to 920 billion is such a small percentage that the price of Bitcoin won't change at all. Or, well, it'll be such a small change that no one will notice it. But if, let's say, we'll pick something like Altura, which is an altcoin with a very small market cap of only 80 million, well, if suddenly there was $10 million coming into Altura, that would alter the price quite significantly. So that's why it's important to look at the market cap, because essentially it shows you how volatile an asset is, how rapidly the price can change when, for example, an influencer tweets about it or makes a video about a particular cryptocurrency. If it's a small market cap cryptocurrency, the price can go up or down quite rapidly, while if it's a large market cap, the price will probably not change at all. So basically, the larger the market cap, the less risky the investment. Of course, you have to bear in mind that cryptocurrencies in general are very risky because the technology is very young. It's completely unregulated sector, so you have to be careful. But essentially, the sort of top 10, top 20 coins are generally the most secure ones. Some of the cryptocurrencies exist on the same blockchain. For example, a lot of cryptocurrencies exist on Ethereum blockchain, but other cryptocurrencies may have their own blockchain. So for example, Bitcoin is a separate blockchain to Ethereum and separate blockchain to Binance Smart Chain or Binance Coin. And that's yet separate one to Cardano and so on. Each blockchain may have slightly different purpose, slightly different features. For example, Bitcoin blockchain is relatively slow. Ethereum is very decentralized, but it's quite expensive to conduct transactions, especially when the network gets busier. There is no one perfect blockchain for all uses, so there will be no situation in the future, or it's extremely unlikely that there will be just one master blockchain. Most likely there will be multiple blockchains, which will all perform slightly different tasks or will be used for different purposes. You have to be aware that you cannot send tokens between different blockchains because essentially they are not compatible, and it will result in tokens being burned, so they'll just cease to exist. So you will lose your funds, and there is no way to revert that transaction and no way to complain or in any way to get your funds back. Luckily, most platforms will give you a warning when you want to send tokens between incompatible chains, or sometimes they will stop it altogether, but it's just something that's very important to keep in mind. So for example, you cannot send Bitcoin to Ethereum blockchain or Ethereum to Cardano. They're just not compatible. There is a function called bridging, which allows you to send certain assets between different blockchains or certain different blockchains, but we'll not look into it in this video. It's something a bit more complex. So what all those cryptocurrencies actually do? Well, it depends. They all have different purposes. For example, Bitcoin was created as a currency, but actually now is used as a store of value, because there is very limited amount of Bitcoin. There will be only ever 21 million Bitcoin in existence. And actually probably it will be less because it will take a bit of time to mine all the Bitcoin. And also some Bitcoin was lost when it was being transferred to different networks, incorrect networks, or in early days when people simply didn't care about it because it wasn't valuable. So a lot of people lost access to their wallets and lost thousands and thousands of Bitcoins in them. So let's assume that there is 20 million Bitcoin, and at the moment there's around 8 billion people on the planet. So if you wanted to distribute all Bitcoin equally between all people, that would be something like 0.0025 Bitcoin per person. So you can see that it's a very scarce asset, similar to, let's say, gold. And that will be probably, going forward, the main use case for Bitcoin, not necessarily as a method of payment, but as a store of value, just much more convenient than gold. Ethereum, it allows you to create and execute smart contracts. Smart contracts, as the name implies, is a contract that executes itself when certain conditions are met. So it could be something as simple as transferring funds between two wallets. But it could be also, for example, self-executing insurance policy, which will pay out to the person who bought this policy when certain conditions are met. For example, if there was inclement weather for a certain period of time. There are other coins like, for example, Tether or USD coin, which are called stable coins. As you can see, their price is either exactly $1 or around $1. Basically, they are pegged 1-to-1 with the dollar, and there are also similar stable coins for other currencies or some other currencies. So the idea is that you can, for example, sell your Ether and keep those funds in Tether rather than withdraw them into fiat currency and then to the bank and so on. So basically, you can temporarily put it in something a bit more stable than most other cryptos, and then use those funds again to buy, for example, Ether when the price goes down. And so on. There are many other cryptocurrencies which fulfill a variety of purposes, and some of them serve no purpose at all, like meme coins such as Dogecoin or Shiba Inu. They don't really, at least at the moment, have true use case. They literally started off as a joke and then just picked up. So there's all sorts of stuff on crypto space, in the crypto space. But then when you click on particular coin, you can get more information here. You can see the market cap, you can see circulating supply, you can see how the price changed, and so on. But this section here is quite important because it will tell you what's the website of the project. You can see on what explorers you can see transactions. For example, you can go to Etherscan and see all the transactions that are happening on Ethereum Blockchain. And also you can find all other resources here. So if you want to find out more about a particular project, it's good to just go through the links and essentially find out more, either on the website or Telegram or Discord, Medium, and so on. And if it's a decent project, legit project, there will be plenty of information, and you should be able to get pretty good understanding of what it does quite easily. And why cryptocurrencies are so volatile, or why some of them are so expensive? Well, the price is largely driven by what people are prepared to pay for it, right? So like with the case of Bitcoin, because it's so scarce, people are willing to pay quite a lot of money for it. Ethereum is the most widely used blockchain. It has the most functionality, and this drives the price up. It's of course at the moment highly speculative market. People are expecting that cryptocurrencies will be worth much more in the future. And with things like Facebook changing its name to Meta and focusing on metaverse, former CEO of Twitter focusing on metaverse, essentially everything gravitating slowly towards metaverse. Well, you cannot have metaverse without crypto and NFTs. So within the next 10-15 years, cryptocurrencies and NFTs will be as mainstream as internet is now. But until we reach that stage, the market is likely to be quite volatile, and there will be a lot of speculation. And the volatility comes largely from the fact that the overall market cap, so the total amount of money in the crypto space, is relatively low. It's around $2.3 trillion at the moment. You may think that 2.3 trillion is a lot of money, but if you look at, let's say, something like Apple, okay, it's the world's most valuable company, but at the end of the day, it's just one company. And that company alone is worth 2.78 trillion. So more, quite a bit more, than the whole cryptocurrency market overall. The total value of gold, for example, is around 10 trillion. So basically, crypto is volatile because there is relatively little money in it. And people who have a lot of money, or a large number of smaller investors buying into a single project, can move that price up and down quite a bit. So I talked quite a lot about one use of blockchain, which is crypto. The second popular use of blockchain at the moment are NFTs. And you can explore them a bit more on a website like OpenSea, which is basically like an eBay for NFTs, where you can look up for various projects. You can look at current rankings and see what's currently most popular and get into various projects. And I will put a link to a separate video I created about NFTs, which explains in detail what NFTs actually are. But in short, NFT is also a token on a blockchain, just like, say, Ethereum. But while Ethereum is fungible, so every Ethereum token is exactly the same, NFTs are non-fungible. So basically, each NFT is a complete unique entity. So It's not the JPEG actually that you're buying as an NFT, but it's the blockchain part of it. You could call it its ID on a blockchain, which is almost like a signature and proof of authenticity in terms of traditional art. And NFTs can be used for a lot of things. At the moment, they're mainly used for selling digital art, but also they could be used pretty much for selling any property and any asset, like, for example, different weapons and skins in video games. You could technically sell your car as an NFT, or your house, or in the future, there's pretty good chance that any transfer of assets will involve NFTs. So this is, of course, just a very brief introduction to NFTs. And like I said, if you're interested in them, please check out my other video. And for now, we'll move to, well, sort of where to start with crypto. So first of all, well, you need to be able to purchase cryptocurrency. And you usually do it on one of the main centralized exchanges, such as Coinbase, Binance, FTX. There are many others. And if you go to CoinGecko, you can go, for example, to Ethereum, scroll down, and you can see here all the exchanges which list Ethereum. There's a lot of them because, of course, because Ethereum is really popular. For some other coins, there will be fewer of those. And which exchanges you can access will also depend on the country where you live in. For example, Binance is heavily restricted in the United States. So you may not necessarily be able to access it, or at least not to the same extent as people living in some other countries. In my experience, Coinbase, the non-pro version, is the most user-friendly. So if you're a complete beginner, that's probably where you want to start. But I would seriously recommend to open accounts on different exchanges, because not all tokens are listed on all exchanges. So sometimes you may find that, for example, you can buy a particular token just on Coinbase, while some other token just on Binance. Other than centralized exchanges, there are also decentralized exchanges, such as Uniswap, which basically allow you to trade cryptocurrencies directly with other people. So there is no one central organization that holds the funds and conducts all the trades. Essentially, you do it with others. And again, there is another video which explains it in much more detail. And also the important thing with decentralized exchanges or DEXs is that you can access certain tokens on them before they hit the main exchanges. Because a lot of new tokens, when they first come out, they're only available on those decentralized exchanges, and only after a while they will start being listed on centralized exchanges such as Coinbase or Binance. To interact with an exchange like this one, you need something called Metamask. And Metamask is a wallet. It's just a browser extension, so you can install it in your Google or Brave browser or many other browsers. And basically that allows you to hold your own crypto. So if you, let's say, buy your crypto on something like Coinbase, you have your own account on Coinbase, but it's still held in a Coinbase wallet. So if the exchange gets hacked, you could potentially lose your crypto. That's why there is a phrase in the crypto space, not your keys, not your crypto, which basically means that unless you hold all the private keys to the wallet, you don't really fully control your crypto, because there is some other organization that could take over it. If I hold my funds in, let's say, Metamask, technically the wallet could at some point become defunct. But if I have all the private keys, password, and all the details, I can then recover that using another wallet. So because the funds are not really, essentially the crypto is on the blockchain, and the wallet is just a way of interacting with it, if that makes sense. So I strongly recommend that you set up at some point a wallet such as Metamask, because not only it allows you to keep your crypto off the exchange, but also it allows you to interact with many protocols, such as decentralized exchanges, or staking, or buying NFTs, and so on. For example, if you want to buy or sell NFTs on OpenSea, you will need to connect a wallet to it. And you can do it with certain exchange-based wallets as well. But Metamask is by far the most accepted wallet. Pretty much any protocol will work with it. And then finally, if you start trading different cryptocurrencies or if you start trading NFTs, you will most likely be conducting this on Ethereum Blockchain. And all transactions on Ethereum Blockchain require gas fees. Essentially, it's a fee for processing a transaction. I'll put a link to another video where I explain gas fees in much more detail. And you can also see what are current gas fees on websites like, for example, BlockNative. But basically, the faster you want the transaction to go through, the higher the fee you have to pay. But also, the fee will depend on how complex the transaction is. So the simplest transaction is transferring ETH from one wallet to another. Transactions like, for example, minting an NFT or exchanging different tokens can introduce much higher gas fee. And also, the busier the network, the higher the gas, because essentially, well, this is how it works at the moment. This will likely change in mid-2022 when ETH 2.0 is supposed to be rolled out. But at least for the time being, the price of gas largely depends on how congested the network is. But if you want to find out more, please check out video in the description where I talk about gas fees in much more detail. So I think that's it from this video. I know it's a lot of information and I know I skimmed over quite a lot of it, but I think it's a good starting point to the whole crypto space. And from this point, well, you can watch other videos or other linked materials I put in the description or at the end of the video. And if you have any questions, you can also put them in the comments section. I'll try to answer or give you relevant materials. It can be quite daunting to start with, but it's an extremely exciting space, I think. And where crypto is heading is, well, I think it's going to be quite amazing. So it definitely makes sense to start with it. So I hope you enjoyed this video. If you did, please hit the like button and subscribe to the channel. And I'll see you next time. Thank you for watching. Bye.